a lot of the old school names, but it's the Mag 7 that everybody really likes to talk about often because they own a lot of that. They can't help it if they own the S&P or the NASDAQ. Tell me a little bit about the AI trade.
Well, I think that that's going to focus more intensely now that we're getting into later quarters of earnings. And, so far it's been, trust me, build it, and they will come. I'm starting to think now that these next quarters will focus more on what's your business plan. You spent all this kind of money on CapEx, and when are we going to see results? So I'm hoping that there will be a focus on more of the execution of solid business plans behind AI, Nicole. So far, we have just been investing, or I would say spending CapEx on the faith in the hope that this is going to come through with something that's going to be very, very beneficial to the Mag 7, for instance. But so far, I think they're coming up short, don't you?
Well, I don't have a thought because if I did, I think I'd be in big trouble, so especially since I'm not a registered advisor. However, I will say there's concern about the CapEx spending, and you talk about billions and billions and the circular spending that we're seeing from one tech company to the next. And the Mag 7 in each quarterly report, sometimes we balk at the numbers. And when do they become when do investors become a little tired, a little jaded, saying, how much are you spending? Where's the monetization? When do we see the return on investment on this? And do you think they'll sour on some of these Mag 7 names?
It is so difficult to predict when that focus will pivot to an intense focus on those questions. But so far, we have really been patient in giving them a wide swath to report their CapEx. And when the discussion comes to what are you going to be doing with the AI, so far that has been a very thin discussion, and I'm hoping that that will pick up. But it's so hard to predict this thing. For instance, this could go on for several quarters. I'm not saying that this quarter is going to be the make-all quarter where it actually does focus, but I also wouldn't be surprised if we woke up one morning and all of a sudden the attitude had changed by the investors, and all of a sudden they started focusing on these questions. I mean, it is extremely important. I feel like I'm probably one of the only people on this side that focuses on where is your business plan. So far, people are focusing more on how much have you spent, and are you staying competitive with your competitors in terms of spending that CapEx, because you don't want to get behind. I mean, if you remember, I think it was about 18 months ago, Meta's CEO said, we have to keep spending because we don't want to fall behind our competitors. That, to me, sounds a little bit hollow in terms of a rationale.
So tell me about where investors should be putting their money to work. I mean, how do you said, what's your plan, you were saying. Yeah. What is the plan?
Yeah. Well, I think you can avoid some of these really narrowing, nagging questions, in fact, by looking at other sectors. So what, in our opinion, what we like are European defense companies. We think those are very, very solid, and that's a NATO defense play that I've been playing since, frankly, the beginning of the year. And we also like cybersecurity. Ironically, I think cybersecurity will benefit from AI because once the bad actors get a hold of AI, they're going to also improve their game, and so that's going to put more demand on cybersecurity. And lastly, and I might get booed out of the room for this, but in terms of coal industry, we do think that the current administration has been quite vocal about enforcing and supporting coal production now. And so companies like Peabody Energy, for instance, or Peabody Energy, BTU, is a company that we think has great prospects given what the current administration's attitude is toward coal.
Even though NVIDIA recently announced agreements with Intel and OpenAI and showcased a number of new products, the company's market share in China fell to 0, yet its shares are up 5.7% over the last 90 days. The stock has handily outperformed the S&P 500 and NASDAQ over the past 6 months, and it is currently 86.9% higher. Reactions to the continuous recovery from the spring low, however, have been conflicting. Although some analysts have increased their price estimates, others warn of persistent challenges brought on by the uncertainties surrounding future trade relations between the United States and China, as well as the possibility of more stringent restrictions. Since releasing mixed first-quarter earnings, which one analyst referred to as a victory, NVIDIA, the top artificial intelligence AI chipmaker, has been navigating a crucial moment. Although the second quarter report's top and bottom lines were excellent, its outlook did not live up to the lofty standards set. It should be noted that the chipmaker's recent advances helped offset the sharp decline in stock prices that occurred in early 2025, when it said it would incur a $5.5 billion loss related to export limitations for H20 chips to China. Resilience is indicated by the company's shift to U.S. investments in AI infrastructure. 24/7, Wallstein examines if NVIDIA can maintain its comeback and spur additional growth in light of analysts' strong demand for data centers. As it negotiates trade constraints between the United States and China and high market expectations, NVIDIA faces formidable challenges. The significant write-down mentioned above occurred in the first quarter as a result of export regulations on its H20 AI chip, which was created especially to get around export limitations on cutting-edge technology to China. Analysts estimated that the prohibition might cost the company $9 billion in lost sales. The first quarter's fiscal performance would be impacted by about $700 million, with the remaining $8 billion being distributed across the second and third quarters. As competition from Huawei's Ascend chips increases, supply chain costs were also threatened by new U.S. tariffs and China's punitive actions, especially for components imported internationally. Analysts warned about margin pressure due to these issues. NVIDIA's profitability is still strong, though. Due to the taxes, the company reportedly increased the prices of several of its most popular GPUs by 10% to 15%. It raised the price of high-end AI GPUs by up to 15% and gaming processors by 5% to 10% to offset rising production costs and maintain steady profits. However, NVIDIA's supply chains are strengthened by investments in U.S. AI infrastructure, which are backed by its $37.6 billion cash reserve and Taiwan Semiconductor Manufacturing's $165 billion development of its Arizona fab. The agreement that CEO Jensen Huang revealed during Trump's trip to Riyadh is particularly noteworthy. NVIDIA will sell 18,000 of its most sophisticated GB300 Blackwell processors to Humane in Saudi Arabia for use in 500-megawatt data centers. Furthermore, Grandview Research projects that the AI market would expand at a 37% CAGR through 2030. This helps NVIDIA reach its revenue target of $170 billion in fiscal 2026, which is 30% more than the $130.5 billion it made in 2025. NVIDIA reported a record $46.7 billion in revenue for the second quarter, of which $41.1 billion came from its data center division. Due in large part to the fervent demand for its AI chips, the total increased by 56% year-over-year. In fiscal 2025, the chipmaker made $3.2 billion in capital expenditures to develop the infrastructure for AI and Blackwell accelerator production. To fulfill hyperscaler demand, the company's capital expenditures have increased by more than 200% this year, reaching over $3 billion. The United States' trade limitations with China still carry hazards. Even with a possible thaw, tariffs could increase prices, which would account for the purported price increases. NVIDIA's adjusted operating income of $25.1 billion was canceled out by a 39% increase in operating expenses to $3.7 billion for R&D. However, data centers are not the only factor contributing to NVIDIA's rise. Thanks to alliances with Toyota and Aurora Innovation for autonomous vehicles, the company's automotive division grew by 103% year-over-year to $570 million. In light of tariff uncertainty, this diversifies NVIDIA's holdings. NVIDIA's third-quarter fiscal revenue is expected to be $54 billion, give or take 2%. No shipments of its H20 chips to China are assumed in this forecast. For NVIDIA shareholders, this year has been somewhat turbulent. In April, the stock fell to 86.62's a 52-week low. The share price rebounded following the first quarter results and an apparent halt in U.S.-China tariffs. It recently reached a record high of $195.62, bringing the market capitalization of the corporation to about $4.8 trillion. Analyst sentiment is still optimistic, even though at least one officer is still selling stock. 10 of the 64 analysts that follow the stock have strong buy ratings, while the other 59 advise purchasing shares. They now have a consensus one-year price objective of $218.51. That aim indicates a potential upside of more than 20% from the present price. The current range of targets is $100 to $320 per share. With a street-high target price, HSBC upgraded the shares to buy. It highlighted NVIDIA's significant earnings potential by 2027, as well as the growing demand for AI chips. Mizuho and Cantor Fitzgerald both recently kept their buy-equivalent ratings. NVIDIA was well-positioned for success in 2025, thanks to its leadership in AI, 93% growth in data centers, and automotive alliances with Toyota. But care is needed due to tariff risks and DeepSeek's competitive AI algorithms. NVIDIA's financial buffer and Stargate project role provide stability, while the rise of the AI market and the chipmaker's $47 billion second quarter revenue position it to reach its $170 billion full-year revenue target. However, there are still issues with value. Growth-oriented investors should purchase NVIDIA, but others should proceed with caution. NVIDIA's year-end price forecast of $194.30 per share, which represents a 7.3% increase from the current price per share, is set by 24/7 Wall St. This estimate takes into consideration anticipated Blackwell supply restrictions, DeepSeek competition, and tariff threats. It also takes into account NVIDIA's dominance in AI and its revenue projections for the second quarter of 2026. The target estimate shows a cautious but reasonable view because it is lower than the analysts' mean. Is a regulatory crackdown on NVIDIA's AI empire inviting after the OpenAI deal? As AI adoption accelerates, NVIDIA and Accenture are strengthening their current collaboration. The two are placing bets that NVIDIA's cutting-edge AI chips and Accenture's extensive worldwide IT consulting business are a marriage made in AI heaven. The agreement will probably not be a game-changer, but both businesses stand to benefit greatly from it. The increasing use of artificial intelligence, AI, has been one of the most significant secular tailwinds of the last few years. According to many analysts, this is the most significant development since the Internet's inception. Because of the enormous potential for productivity gains, companies are rushing to use these next-generation algorithms and claim their portion of the anticipated bonanza. In order to address the extraordinary demand for these cutting-edge software tools, generative AI's immense promise has spurred numerous collaborations. To assist companies of all sizes benefit from AI, tech consultant Accenture and AI chipmaker NVIDIA are growing their current collaboration. With the establishment of the Accenture-Nvidia business group late last year, NVIDIA and Accenture's cooperation saw a major expansion aimed at assisting businesses worldwide in quickly scaling their adoption of AI. In order to help clients rethink procedures and accelerate enterprise AI adoption with AI agents, the two began their expanded partnership by educating a staff of over 30,000 subject matter experts. The Accenture AI Refinery was also presented by the two. NVIDIA's AI Foundry, AI Enterprise, and Omniverse are integrated within the platform to assist users in developing and implementing unique long language models, LLMs. By adding domain-specific knowledge, these systems could be tailored to solve problems unique to a certain organization. With the Accenture AI Refinery, agentic AI will be available on all public and private cloud platforms, making it accessible to a broad range of companies. But that was only the start. To satisfy the increasing need for sovereign AI, Accenture and Nvidia have strengthened their relationship in recent months by implementing the AI Refinery platform in Europe. Nvidia defines sovereign AI as the ability of a country to generate AI using its own workforce, data, infrastructure, and business networks. By 2030, Europe will account for 30% of the worldwide market for sovereign AI, according to Accenture, which is a largely unrealized potential. The partnership is bridging the knowledge gap by giving companies the tools they need to deploy AI by fusing NVIDIA's AI know-how with Accenture's business savvy. Accenture and NVIDIA have both benefited from the rising demand for AI. Accenture's fiscal 2025 fourth quarter ending August 31st saw a 7% year-over-year increase in revenue to $17.67 billion, while its 2.25 earnings per share, EPS, increased by 15%. More significantly, it brought in $21.3 billion in new reservations, indicating a promising future. The business stated that its early AI initiatives contributed to its impressive outcomes. Additionally, Nvidia's earnings were really strong. Despite a ban on selling chips to China, the company's fiscal 2026 second quarter ending July 27th saw revenue increase 56% year-over-year to $46.7 billion, and earnings per share of $1.08 increase 61%. Will this transaction change the game? This type of partnership's greatest value is that it leverages each company's strengths for the benefit of both parties. NVIDIA has the cutting-edge CPUs required to deploy AI solutions, and Accenture is aware of consumer demand for AI. Currently, Accenture provides its extensive client base with over 53,000 consultants who have received training on NVIDIA's technologies. Accenture, one of the biggest networks of IT consultants in the world, is in a unique position to contribute to the widespread adoption of AI. This, along with NVIDIA's market-leading AI hardware and software solutions, gives Accenture's more than 9,000 clients in more than 120 countries worldwide a one-stop shop. Although they will probably appeal to various investors, NVIDIA and Accenture both have potential benefits from an investing perspective. Accenture is currently selling for about 16 times next year's earnings, making it an enticing investment. Regrettably, the stock has dropped 36% in the last year due to uncertainties in the overall economy. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.